The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Risk off in the Middle East means risk on for Wall Street. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the United States. Take a look at the S&P 500. A lot of optimism over the reopening of the Strait of Hormuz. You can see that in the S&P 500, higher by about 1.1%. We were higher to the tune of 1.5% a little bit earlier in the day, but certainly some big gains here. A lot of that comes down to what we're seeing in crude right now. When you take a look at Brent, lower by 8%. We were below $90 a barrel a little bit earlier in the session, similar to what we're seeing in the S&P 500. Those moves retracing a little bit. Then you take a look at the bond market. I put the 2-year yield here because you are seeing bond traders rethink what this means for the Fed. If we do see some of this situation calm down, if we do see oil really calm down here, what that's going to mean. 2-year yields dropping 7-8 basis points. That is good news for the Russell 2000. The small caps in charge today, Romaine. That index higher by about 2%.
Big moves all across the board, Katie, but when we look at stocks and going from oversold to overbought in just 11 sessions, a phenomenal relief rally turned a risk-on surge fueled by that unwinding of equity hedges, fueled by that systemic stock buying, and fueled, of course, by a lot of short covering of those macro products. A V-shaped recovery accompanied by a drop in market volatility back to those pre-war levels. You can act surprised if you want, but a lot of folks on Wall Street, at least those that pay attention to corporate fundamentals, they called this shot days ago.
As the war occurred, the earnings expectations continued to increase at a faster pace. So the analysts didn't get the war memo, and they didn't get any feedback from the companies they follow that this is a concern for earnings anytime soon.
Now, analysts next week will get a fuller picture of the corporate cards on the table, with a fifth of the S&P 500 companies scheduled to report. That includes Boeing and United. It includes Intel and Texas Instruments, IBM and Tesla, and American Express and Synchrony among the notables. But before we get too enthusiastic, just a pinch of salt. The still nascent earnings season so far has produced mixed results. You just take a look at the reaction today to Netflix's tepid guidance from last night. Furthermore, some strategists, they're now concerned that equity prices no longer factor in the downside risk of higher inflation or of slower economic growth. And the head of asset allocation over at Goldman, he's actually questioning whether rally is even sustainable, Katie, without Fed support.
Well, we'll see if that ultimately comes to fruition. But at least when it comes to the big indexes, particularly the NASDAQ 100, what a streak we're on. The NASDAQ 100 higher now for 13 straight days. We haven't seen that since 2013. And I thought it was really interesting, this chart coming from our charts producer, Dan Curtis, that you take a look at performance after a streak of 12 or more gains. It typically portends more gains in the offing. The 6-month performance, you can see the last time we were here was 2017, 2013. We're talking double-digit gains on average. Then you take a look at 2010. Things were a little bit different, but take a look at then the 12-month performance. A lot of momentum following some of these consecutive streaks that we've seen. So we'll see if history repeats itself once again, Romaine, or whether or not we're going to get some of those other forces coming in and sort of breaking up the combo here.
Yeah, absolutely. Well, one way or another here on this April 17th, this is going to be a historic day to some measure or another. Where do we go next? Sinead Colton Grant joins us right now, Chief Investment Officer at BNY Wealth. Great to see you, Sinead.
Great to be here, Romaine.
I won't ask the dumb question of where we go next, but I do want to ask you whether you're actually surprised at just how quickly the market snapped back.
Well, and before I say that, can I just say, what a week. Oh, my goodness. Look, here's what we've been talking to our clients about. How important it is during periods of geopolitical tension to focus on the fundamentals. What are they really telling you? And yes, we do still need to watch inflation closely, but when you look at earnings, we're still expecting double-digit earnings growth. When it comes to interest rates, because of the Fed's dual mandate, we're not really seeing much in the way of a change in pricing, taking back a few cuts, but no real hikes like you are for expectations for other central banks. And the consumer is still solid, right? Even though we're seeing higher prices at the pump, it's being offset with a higher tax refund cycle. So makes sense to focus on the fundamentals. The fundamentals would tell you that the markets should be higher.
There is an argument out there that when you look at the quote-unquote real economy, I put that in quotation marks, that there is a little bit more pain under the surface. We're talking still about elevated oil prices, fuel prices, and everything that feeds into that. That's not necessarily going away immediately. It's going to take some time to get down. Does that have a material economic impact to the point where it would affect corporate earnings?
Well, and here's the point, right? The market is not the same as the real economy. There are confluences, of course. What we're watching most closely is the evolution of inflation. I hesitate to use the T word, the transitory word. However, temporary. If, as we're seeing today, oil prices have come down a lot, then that impact on inflation will be relatively brief. But look, we've always been expecting slightly higher inflation at the end of the year. The midpoint of our forecast has been 3%, and that has been our forecast since the beginning of the year. Look, we need to watch it closely. But the reality is, when we talk about the consumer, we know that it really has been the top 10% of consumers that have really been buoying the economy, that have been continuing to spend at elevated levels. And for those consumers, it really is what's happening with financial markets, with asset prices, that is the bigger determinant of spending.
Yeah, absolutely. The wealth effect, it sounds like what you're saying, that matters more for that top 10% or so. But, when you think about the rest of the, shopping base of this country, the rest of the consumers in this country, the fact that you do expect, a little bit higher inflation than maybe the average bear, I mean, how does that sort of translate into portfolio sort of construction here? Are you shying away from those companies, and industries that are more reliant on consumer spend versus, a tech company, for example, which really seems to be benefiting from companies spending on companies?
So where we think there is a lot of opportunity right now is certainly in tech, where we've seen over the past couple of months significant re-rating. The multiples now are in the low 20s as opposed to 30 or so at the end of last year. That certainly looks more attractive, particularly the hyperscalers that are significantly benefiting from AI. But we also like industrials, where they're poised to benefit in a slightly different way from the AI revolution. And financials also look interesting. So again, those sectors, it's not a tilt away from the consumer, but more the factors that appeal within those industries themselves.
Talk to us a little bit more about financials, because, again, I mean, we're coming off of the big bank earnings this week. We're going to get into some of the smaller names in the weeks ahead. I've heard a lot of calls today. I was filling in on real yield for a steeper yield curve. How does that all interact with financials overall? Well,
and look, the evolution of the yield curve from here, we certainly have seen a higher term premium priced in over the last couple of years. But we're watching closely the evolution of inflation, as I mentioned. But here's what we're also starting to see, which is the pickup in M&A, the pickup in transactions, which clearly feeds through to the bottom line of some of those larger financial firms. But what's going to be really interesting to look at is how the regional financials do. So those smaller banks that are more dispersed throughout the country, as opposed to located in the major financial centers, because that will give us a better pulse on how their businesses are doing through all of this. But certainly for the larger financials, the pickup in M&A activity, as we see regulation becoming a little bit more favorable, we're also likely to see a lot of IPO activity this year. Again, favorable for many of those names.
When you say IPO activity, you mean in terms of the volume of deals, or because obviously there's a couple of gorillas that are coming out of the midst here that are going to, of course, skew a lot of the numbers. But you think we'll see, in terms of the number of companies coming public, that's going to be material?
More than we've seen, right? I mean, those two big names, we all know who they are.
Yes.
So they are going to, I think, scatter a little bit of stardust around IPOs. For every company, it's an individual decision, but I think we're likely to see a little bit more than we have in recent years, because certainly if we continue to see equity market performance like we have over the last few sessions, that's going to make it look a lot more appealing.
I do wonder, though, going forward, what the driver of this market is, because for the last 6 weeks, the last 2 months, maybe it feels like it's really been oil in charge. I mean, what do you think that leadership sort of hands off to from here?
It's a great question, Katie, because right now we're looking at net margins that have jumped another, call it just over half a percentage point. They're sitting at around 15% in aggregate now. That's pretty much the highest that they've ever been. And so it's not impossible that they could go higher. but it's likely to be slower. And so that means we expect there's going to be more heavy lifting from earnings directly. We think that the continued rotation will be helpful, right? That it's not just the Mag 7 that are doing a lot of the driving. So we need to see more of those fundamentals coming to the fore and continuing to strengthen. And look, you mentioned one of the big risk factors, which was inflation. But the other is that, you know, the market is expecting another year of double-digit earnings growth. If earnings start to disappoint, then that is going to be a headwind for the market. But so far, it looks pretty constructive out there.
It certainly does. Sinead Colton Grant, Chief Investment Officer over at BNY Wealth, as the S&P 500 heads towards its best weekly gain in almost a year. And that, of course, is on the back of increased optimism that the worst is behind us when it comes to the situation in the Middle East. Ships now racing to get in and out of the Strait of Hormuz, but a lot of questions out there still unanswered. We're going to catch up with Kay Bailey Hutchison, the former U.S. ambassador to NATO.
Plus, as the current geopolitical environment carries into markets, we'll discuss the other story moving equities, earnings reports. A slew of tech names reporting next week. We'll get the breakdown from Ray Wang. He is Constellation Research CEO.
And of course, we are going to talk a lot about technology, a lot about AI, a lot about how it's transforming the landscape of a lot of industries, and that includes accounting. We're going to catch up with the CEO of Rillet AI. He's going to be joined by Alex Rampell, the general partner over at Andreessen Horowitz. You don't want to miss that conversation. Stick with us. This is The Close on Bloomberg.
Bitcoin hitting a 2-month high on optimism around a path to resolution in the Middle East. Those gains coming at an advantageous time, right on the heels of the Department of Labor's proposed rule paving the way for alternative assets in 401k retirement portfolios. Our next guest oversees more than $687 billion worth of BlackRock's retirement plans. His name is Nefouse. He is Global Head of Retirement Solutions and Head of LifePath, Multi-Asset Strategies and Solutions over at BlackRock. Nick, it's great to see you.
Thank you for having me.
So I was reading over BlackRock's earnings call transcript, as I often do, and we heard a lot from Larry Fink when it comes to retirement and how the firm is seeing that sort of as a strategy going forward. And I wonder, you know, from where you're sitting, how do you make sure that BlackRock and LifePath remains ubiquitous when it comes to America's retirement systems?
Yeah, so first and foremost, BlackRock is a retirement company. So 50% of our assets are invested for retirement. About 80% of Americans are invested in 401k or 401k type plans. So what our goal is, our primary goal is how do we help more Americans get to retirement and be able to spend in retirement? The mantra that we've been looking at is we want to take these target date funds and really turn them into individual pension plans. So the DB plans are going away, but what we want to do is take a lot of these assets that we've been able to own in DB plans, but we haven't been able to get into target date funds. And this is where the DOL is so important. So things like private markets, things like guaranteed income, putting those into your 401k plan and hopefully into your target date fund. So we don't just help you accumulate wealth during your working years, but in retirement, you can then have more guaranteed income or certainty of income and hopefully higher returns during those working years.
And so I am curious, though, Nick, when we talk about sort of what changes that we've seen in terms of demand, in terms of what people want to see here. I mean, obviously, generation to generation, we've seen shifts. The whole idea of the traditional 60-40, even on a target date basis, and that adjustment has kind of gone out the window. A lot more focus, obviously, on getting alternative type of assets in there, whether it's real assets or maybe something a little bit more ephemeral. How do you work those in?
So first off, everything has to be done through choice. So we want to give investors choice. Some people may not want those types of assets, other people do. What our goal is, first and foremost, is delivering retirement outcomes. So we have a benchmark that we have to manage against. We have cash flows that we have to manage against. We want to put assets in the portfolios that are going to improve those outcomes.
Has the risk profile, though, changed? I mean, I know generally when we talk about the trajectory, you know, obviously people who are younger obviously have the ability or maybe the want to take more risk, and that sort of decreases as you age here. But have you seen any shifts in that at all?
So I wouldn't say the risk profile has changed. What I would say is people are more aware of the risks of doing it on their own. So go back 10, 20, 30 years, you had a defined benefit plan. It was a defined benefit. It was paying you something out. Now what happens is we've done an incredible job in the U.S. of institutionalizing accumulation. So we've gotten people involved in 401k plans. We have target date funds. They get to retirement, and then it's fragmented. So how do we help them in retirement? That's the risk that they're seeing. And what we hear more and more people want is they want certainty in retirement. They want some level of a paycheck in retirement for the rest of their life above what they're going to get from Social Security. If 80% of Americans are already in 401k plans, how do we bridge that gap and provide guaranteed income, provide more certainty in retirement?
And, you know, I do want to go to a line that you put in your notes that active management is critical now as retirement is rewired, because, I mean, at first glance, you could think that that's unintuitive, right? You're supposed to put money away for retirement, maybe put it in index funds or with BlackRock and then not think about it. But talk to us about how you are approaching, you know, active management when it comes to these types of portfolios.
Okay, it's a great question because we tend to, in the market, think about you're either an index manager or you're an active manager. An active manager is picking which stock you like more or less. The way that we have to look at this is it's a total portfolio approach. So if you're going to include guaranteed income, if you're going to include private markets, those are active decisions. If we look at the market environment that we're in now, you can see that we're in a different market regime. It's not ultra low interest rates with a very supportive central bank with things like QE. So we have these different macro shifts happening. All of that leads to more active. Now that doesn't mean you're going to take all of the index dollars and everybody's going to be fully active, but you have to have more oversight of these portfolios. It's not post 08 anymore where you can just buy beta and let markets go up.
Nick, great to have you here. We got to get you back to talk a little bit more about this, particularly as the retirement landscape shifts. Nick Nefouse is Global Head of Retirement Solutions and Head of LifePath over at BlackRock. When we come back, it's time for our Stock of the Hour, and we're going to take a closer look at shares of Netflix having their worst day since October, a beat for the most recent quarter, but the guidance going forward causing a little bit of concern. We'll discuss coming up after the break, right here on Bloomberg. Let's get right to our top calls. The big movers on the back of analyst recommendations. And we're going to start it off with Chevron. BNP upgrading the oil and gas producer to outperform. The price target goes to 230. The analyst saying that even as the war against Iran winds down, collapsing oil and product inventories, they've ignited an extended oil upside price cycle that will benefit the bottom line. For now, though, investors shrugging that off, sending those shares down for a third straight day. Next up, Albemarle. Baird downgrading the lithium producer to neutral, holding the price target at 210. The analyst says increased supply coming to market, plus the potential nearing of an end to the war complicates their outlook for the stock, a stock that had rallied 40% amid the Iran war, now having its worst day since March 3rd. And finally, Texas Instruments, Mizuho raising the chip maker to neutral and also nudging the price target up to 215. The analysts believe strong AI server and industrial demand will show up in Texas Instruments earnings, which come out next week. Those shares having their second up for a second straight day, now at a record high. And those are some of our top calls. Let's take a look at a stock that's moving in the opposite direction. Netflix having its worst day since at least October after giving a relatively tepid second quarter forecast. But more importantly, a lot of questions right now about where this company goes after, well, let's just say, walking away from that Warner Brothers deal. Joining us right now to talk a little bit more about this is Paul Dergarabedian, Senior Media Analyst over at Comscore. All right, Paul, we've all seen the numbers. We've all heard the conference call. I do want to start off first with the parting of ways. Basically, we're just not that into you. Warner Brothers is going to do its thing with Paramount, Skydance. Ted Sarandos and Greg Peters, I guess, are just going to keep doing what they're doing. What, Paul, do you think they will do?
Yeah, you know, I think it was interesting that, you know, it's so much talk around this consolidation, Paramount, Skydance, vis-a-vis Warner Brothers. You know, that's a huge deal. And I was just at CinemaCon, and so that was top of mind at the big movie convention there in Vegas this week. And I think with Netflix, I mean, this subscriber growth that they want to build, that's important, but they built that on the goodwill of all these original shows and movies, the library of titles that they have. If they switch more to a monetization growth through either more ads or price increases for their subscription, I don't know how that will play with the audience, with the consumer, for whom the value proposition is very important, but it's also the brand identity that Netflix has that they've been very successful with over the past few years, of course.
Interesting. So it sounds like, you know, in your telling, this is, you know, definitely sort of a bit of a sea change here, sort of a switch off for Netflix, that it sounds like, you know, it's a fine line to walk. And, you know, I wonder how the sort of price hikes that we're seeing through play into this. And, you know, the idea that maybe you do start to see people trade down into the ad tier.
Well, and Katie, you're right. I mean, it's so competitive in the streaming space. Consumers have so many options, including the movie theater, of course. And so those price hikes, so they're incremental and you're already subscribed, but there is a lot of competition out there. So if you want to lower or tamp down that churn rate, you really almost got to stay the course and keep doing what you're doing. I think there's so much reaction, so reactionary by some of these companies when they have a down quarter. It's like, well, what do we do now? Well, maybe if it kind of ain't broke, don't fix it. But then again, this is an ever-changing marketplace. So from day to day, with the dynamics in this marketplace, again, with Paramount Skydance, Warner Brothers deal, theatrical, which is booming right now. We're up over 20% versus last year for movie theaters. It really is a dynamic marketplace, but always changing.
Well, I am curious about that. I mean, what do you think is the sort of the theatrical strategy for Netflix going forward? That, of course, you know, some actors and people in Hollywood had raised some concerns about whether Netflix would be a good shepherd for Warner Brothers Discovery, primarily because of its streaming first idea. Where do you see that going?
Yeah, that's very interesting. What Netflix does have is very deep pockets, and they can provide the creatives, the writers, directors, actors, producers with a lot of resources, money, and creative control. So that's very powerful. But you also want to have a theatrical strategy, because whether it's a George Clooney, Brad Pitt, whoever it may be, writers, directors like Denis Villeneuve, Christopher Nolan, Steven Spielberg, they want a theatrical play for these movies. Of course, episodic TV is meant for the small screen, but feature films, generally, they get their biggest boost on the biggest screen. Yeah. But of course, there are financial dynamics involved in a theatrical release that don't apply in streaming. So you have to pick your battles, which films go to streaming, which ones go to theatrical. But a theatrical first strategy builds buzz and prestige for films that later wind up on any streaming platform.
All right, Paul, really great to get your thoughts. Have to leave it there. That is Paul Dergarabedian. There we go.
Yeah.
He's a senior media analyst.
Have you seen Project
Comscore.
Hail Mary? I wanted to ask you about that. We've run out of time.
Yes.
You saw it already?
Yeah, of course.
In the theater.
I did.
Because that's the whole thing. They just extended the run. They basically said it's not coming out on streaming anytime soon.
Have you seen it?
No, because I have to go to the theater.
I have to say,
I don't go outside.
My husband and I loved it.
Yeah.
We were there with my parents who just could not get into it, did not understand.
There's like a rock or something involved, right?
Yeah, there is. His name is Rocky. He's actually a spider sort of thing.
Oh,
anyway,
spider.
Coming up, we're going to dive into the world of geopolitics. Stay with us. This is The Close.
3:30 p.m. here in New York. This is the countdown to The Close. I'm Romaine Bostick.
And I'm Katie Greifeld, looking at a big Friday finish to this S&P 500 rally for the week. A lot of that comes back to the Strait of Hormuz, you guessed it. Iran saying that it would open the strait for the duration of the 10-day ceasefire between Israel and Hezbollah.
Yeah, and still some conflicting reports here. They're saying they open it to commercial traffic, but not U.S. and Israeli traffic. There's also a lot of questions here about just really a renormalization. I think that's really what, obviously the market's optimistic about the direction of talks, but the idea is like, when do we get back to what that flow of traffic looked like on February 26th, 27th, before we started dropping the bombs?
Absolutely. And I mean, it's really a cross-asset reaction that you're seeing here, from equities to bonds to, of course, oil, which is, of course, the asset class that it feels like many still have their eyes trained on. And President Trump saying Iran is also agreeing to suspend its nuclear program indefinitely. So let's put all of this together with Kay Bailey Hutchison. She is former U.S. ambassador to NATO and current senior advisor at the Center for Strategic and International Studies. Ambassador, fantastic to have you with us. So really curious to just hear your reaction here. We see the reaction when it comes to the financial markets. To Romaine's point, it seems like it's the direction of travel of these negotiations that is fanning all of this optimism. How are you reading the headlines?
I think it is a very optimistic time. Of course, we need to make sure that this continues, that it goes through the next week, through the ceasefire, and hopefully there will be agreements made. I have to say, I think the administration did a great job of saying we are going to address the economic issues. We have economic leverage, and we use that. So I think it is going to be, I hope, the new era of relationships in the Middle East that will be to all of our advantage.
Well, Ambassador, to that point, the hope here is that this will be a new era. But you think about the long history of the Middle East and, of course, the U.S. involvement in that. I wonder what you view as the components that are different this time around that maybe could, in your view, maybe deliver lasting peace here.
Yes, that's a great question, because we want this to be lasting. And I think that is why the president did not walk away. He has stayed the course on the issue of nuclear capability and also the missile issues that became very apparent when Iran hit Diego Garcia. And having done that, I think brought our other Middle Eastern allies, besides Israel, the others came in and said, we think now is the time to see this change. They have been very supportive. We haven't had that kind of universal support in the Middle East before, and I think it is making a difference.
With regards to, I guess, what comes next here, assuming that we do get an extended ceasefire and obviously a return to peace of some modicum or of another, obviously a lot of folks really want to know about Iran's uranium enrichment capabilities and what commitments they can make, or what commitments maybe the U.S. can extract out of them to ensure that those capabilities aren't used towards anything, towards a weapon.
You're getting right to the point of why this all started. And that is because in the past, we have gotten commitments from Iran that they would not be doing more enrichment of the uranium for which would only be necessary for a weapon. And they have broken the agreement time and again. They have not allowed the inspectors in. And this time, we are looking to an ironclad decision with all of the rights to assure through inspectors that they have not violated their agreement, getting all of the uranium that we know they have but is not apparent. I think all of those things are making a difference, and it is the whole basic purpose that for which we have gone through this. I think when you look at what has happened with North Korea getting the nuclear weapon capability because they lied and didn't let the inspectors in, and we didn't press hard enough, I think we've seen the results of that, and we don't want that in the Middle East with Iran.
I do want to get your thoughts. I mean, having been a U.S. ambassador to NATO, about the relationship between the U.S. and its NATO partners, which was, of course, already fractured prior to the war. The president, particularly in his first term, made it clear his dissatisfaction with that relationship. It does not appear that that relationship has improved. The president, of course, made it clear he was upset that he did not get support from some of the NATO countries in this campaign in Iran. Is that relationship, 75-year relationship going on now, is that salvageable?
It is. It has to be. Yes, it is frayed. There is no question that the Europeans are very upset, but it must be healed for all of our good. If we are going to face our adversaries of the future, which would be China as well as Russia, we must have a coalition of the strong economies of the world, and we have to really look at the costs of not having that kind of an alliance. It would be much more expensive for America, and it would not be as productive as if we had the 31 other allies in NATO, but also the Asia-Pacific allies that have been very forceful and helpful when they could be. We need to now try to bring everybody back together and say, okay, we're disappointed, but we've got to move forward. It is in our best interest to do so.
Well, Ambassador, in your view, how do you think that happens? We heard from the president today posting on Truth Social saying that he received a call from NATO asking if we would need some help when it comes to the Strait of Hormuz. And according to the president, he told them to stay away. So clearly tensions remain quite high there. There's communication, but it doesn't seem to be necessarily leading anywhere at this moment.
I think you're right about that, but I think we need to be going behind the scenes and working together to patch up all of the emotions that have been let go here. And I think Europe should have stepped up sooner. I understand that they were offended earlier, and rightly so, but they should have put that aside for the bigger picture, which is we are stronger together and we will work together with our ally, America. Now we've got to, I think, reach out and start bringing everybody back together and saying, okay, we can talk about all of our differences, but this is a family fight, which means that we must come back together.
I mean, I appreciate your optimism, Kay, but I mean, this goes beyond just NATO. I mean, we've seen a kind of a fracturing in a lot of relationships. We've seen a lot of countries and regions, to a certain extent, go on their own, or at least try to go on their own. It's hard to divorce yourself from the world's largest economy. But whether we're talking about Canada or some of the Latin American nations, some of the other Asian nations, there does appear to be this sense here that that sort of a unified global order, whether it was real or not, that we kind of enjoyed in that post-World War II era is just gone. Is that a mischaracterization?
I think it is repairable. I'm not arguing with all of the things that you said, but I think we need to now look at the big picture, and we need to be the leader of the free world and say, okay, we America have done the job of basically defanging Iran, which has been a terrorist organization that has terrorized other Middle Eastern countries, as well as had activities in our own countries. And we must now come together and be big enough to do that. And in addition, I think it is going to be very important that together we look at the bigger picture potential adversaries and realize if any one of our entities wants to go it alone, it's going to be a whole lot harder, a whole lot longer, and a whole lot more expensive.
Ambassador, really appreciate you taking time for us. Kay Bailey Hutchison there, former U.S. ambassador to NATO and now a senior advisor at the Center for Strategic and International Studies. We're going to turn back to the broader markets. In fact, actually, we're going to turn back to some of the individual stocks, some of the big movers out there. And we're going to talk a little bit about Intel. The share's down on the day, but it's actually been on a tear over the last 3 weeks, up more than 60% heading into its earnings report next week. That's our stock of the hour, and it's coming up next right here on The Close on Bloomberg. Time now for our stock of the hour. Let's take a look at Intel. The share is down on the day, but actually headed for their third straight weekly gain, and it's part of what is now a 3-week 64% rally. A lot of optimism about its turnaround plan. Intel adding more than $100 billion in market value just this month alone, and it's got a big earnings report coming up in just a few days. Norah and Mulinda joins us here in Studio 2 to talk a little bit more about this. First, I want to talk about why, because I noticed something interesting. If you have a Bloomberg terminal, you can run a chart. This 64% rally heading into earnings season, this is almost a repeat of what we saw 3 or 4 months ago when we had this big 40% rally heading into earnings season. Then they reported earnings and the shares sold off 20%. So what's going on here?
I mean, the chart is really interesting. I was digging into the chart as well. Quite something charts to look at. I mean, for sure, it adds a nice visual, get an idea of how the company's actually performing. But essentially, we are seeing execution improving. We are seeing a lot of people really bullish about this company. I was reading through some notes. Maley, Gabelli, they're also talking about this idea of they think the stock could potentially run up to $100 a share. Wow. Mind you, I'm looking at the A&R page on the Bloomberg terminal, and an estimate of the price target across Wall Street is about $53 a share.
That's the average? Wow.
Yes, that's the average price target that we're seeing on the A&R page. But they're saying this is if they're able to land some big
which we should point out is below where the stock is trading now.
Right. We should also add that as well. So this is a pretty big swing that they're expecting here, but they're saying that this is all based on the fact of them being able to land some big name customers. There's some speculation about Apple potentially being in the mix, or Nvidia. Those are two names that have been floated that they could potentially announce this year. So there's a lot of investors trying to get in right now as they think about the future ahead.
Well, speaking of Nvidia, you think about Intel's business. I mean, for a while, this was a stock left for dead for a reason, because, taking a look at the competitive landscape, there's a lot of wood to chop there. So where do we currently
I like
stand?
that euphemism.
Wood to chop. Stealing that. Well, we did see really them losing to Nvidia, AMD. If you flash back to 2024, the stock was down pretty substantially in the red year to date. So we were seeing sales down from Intel. We were also seeing that they were spending too big on factories, but now we are seeing some external backing. I mean, of course, some names like Google Google, Tesla, there's the Musk mix that we're seeing with Intel here. So there's a lot of big names that are essentially giving some support, some reinforcement. And that's why you're really also seeing a lot of people rallying behind this name now.
Yeah, but it's also, I mean, I feel like we've always had this idea that they have the potential. It's about the execution.
Right.
And that's always been the issue. I was just looking at more than 50 analysts cover the stock. Only 11 have buys on this stock right now, which shows you just how pessimistic. But maybe that changes. What is it, next Wednesday, Thursday when we get earnings out of
Something like that. That sounds right.
All right.
I believe you if you told me that. Norah, Mulinda, great reporting as always. That is our
April 23rd.
TV markets correspondent. That is Wednesday.
Who knows? But it's April 23rd.
Anyway, I do know that the closing bell is up next. We're going to take you there with Michael Cuggino. This is The Close.
The market is not the same as the real economy. There are confluences, of course. What we're watching most closely is the evolution of inflation. I hesitate to use the T word, the transitory word. However, temporary. If, as we're seeing today, oil prices have come down a lot, then that impact on inflation will be relatively brief.
And she hesitated to use the T word, but the market right now is shrugging all of that off. Sinead, Colton, Grant kicked us off to the close just about 50 minutes ago on what is going to be, Katie Greifeld, another record-setting day for the S&P 500.
Absolutely, and what a week. Looking at gains of 4.5% when it comes to the S&P 500. Haven't seen that kind of momentum since about May of last year, according to the terminal. A lot of that is being helped by what we're seeing in oil prices right now. I mean, you take a look at Brent trading at $90 a barrel, certainly quite a big drop down there.
And don't forget also that drop that we're seeing in Treasury yields too. That's aiding the cause. I was just going through some of these numbers on a weekly basis. I mean, the tech sector, the S&P tech sector, at least up 8% this week. Consumer discretionary stocks up about 7%. And it gets to this idea that obviously people are buying a lot of the stuff that got really beaten down. But also it just seemed like, didn't we have some worries about those sectors that had nothing to do with Iran? And now everyone's like, okay, that's all over.
That's the thing. I'm really excited to get into the earnings for some of the alternative asset managers, the BDC companies. That's coming in the next couple of weeks. And of course, we're going to hear from a broadening out of the sectors as well, because really it's just been the big banks, it feels like, and Netflix. Yeah,
we get Texas Instruments and Tesla, IBM, Intel, and a few others next week. And then after that, of course, we get all those big hyperscalers and Microsofts, and we get Apple and those names as well. So next 2 weeks are really appointment viewing right here on The Close. As we count you down to the close here on this Friday afternoon, Michael Cuggino joins us right now, President and Portfolio Manager at Permanent Portfolio. All right, Michael, let's start off with investor sentiment here. I mean, on one hand, I'm not too surprised by the moves, particularly given that we kind of always knew that the sell-off was a little bit technical and certainly a little bit more of a knee-jerk reaction here. But are you surprised as to just how quickly we not only erased all of the losses from the war in Iran, but right now, at least, really surpassed some of the highs that we had prior to that?
Yeah, the snapback has been as aggressive as the excess downside from a few weeks ago. So, and there is still a big degree of headline risk to all this. So I think the investor sentiment is such that they feel like Iran has it's somewhat under control. There's a plan. It's not as big of a risk factor. I don't know whether all this is accurate, but that's the market sentiment right now. And that'll change until there's different headlines that are saying something different. And so I would caution investors to get too wrapped up in momentum in either direction right now, because I think it really is still being driven by headline risk. And right now the headlines are more favorable than they have been in the previous couple of weeks.
And that's a good point. Of course, the sell-off was largely headline driven, and so too has the rebound. I am curious about the fundamentals, though, particularly as we get deeper into the meat of earnings season. And this narrative that's been out there from a lot of the guests that we've had here on The Close, this idea that corporate fundamentals have probably not been materially affected by what transpired over the past month, certainly not in the past 3 months. But I guess the question is, what type of guidance do we get out of these companies as to maybe the lingering impact, economic impact from the war?
Well, that's a huge point, because I don't think that any of this is going to be really reflected too much in the Q1 earnings that are going to be reported. But watching the outlooks and hearing the outlooks is going to be significant, because the impacts, in theory, are still to come. I mean, if you have energy that's having trouble getting out of the Strait of Hormuz, for example, there's a lot of energy that is already on boats getting to ports before that conflict took place. So once that evaporates, then it's going to be more of an impact on what's coming out now and how long does it take to get there and into consumers and businesses' hands. And, we just don't know at this point. There's a lot of conflicting headlines and news, and I'm not an expert on it. So our view is to stay very diversified right now and hedge our bets in a number of areas because we just don't have clear guidance as to what's happening.
Well, speaking of hedging your bets, Michael, I'm taking a look at your notes. You flagged private credit as a risk worth watching here. Not something to, say the sky is falling over, but certainly something worth monitoring. And I wonder, what that means in context. What are you looking out for there when it comes to private credit, and what is the potential risk?
Specifically for our portfolios, we're not involved in it, so we're spectators. But I think broadly in the market, anytime you have risks to potentially marking debt assets and illiquidity, I think you have to be concerned. Now, having said that, I think maybe the issue is real, but definitely overdone to some degree, and it's a facts and circumstances thing. I mean, much has been made about redemption limits and the investors all trying to get out of the door of some of these funds. And yes, that's significant in terms of investor sentiment, but keep in mind that a lot of these investors signed up for these deals with the terms that have been offered. And it's not such a case of the terms are being changed. It's just that they're exceeding the terms that maybe were expected when the offering documents were listed. So that's not necessarily an issue per se, unless firms have difficulty liquidating assets and paying out redemptions. And so the asset quality is down. The other thing I think is somewhat of an X factor that came out earlier in the week is that, some of the banks have exposure lending to some of these funds. And to the degree that's material or unquantified or there's liquidity risk there, then that spreads to the broader banking sector. So I think it's definitely something to be concerned about. Investors should be concerned about it as a general risk. But unless you're involved in it on a case-by-case basis, I don't necessarily think it's a Chicken Little situation, if you will.
Michael, always a pleasure. Michael Cuggino, President and Portfolio Manager over at the Permanent Portfolio Advisors there, as we continue to keep an eye here on this record rally. And we continue to keep an eye on Katie Greifeld of the AI build-out and the retrenchment, at least on the employee side by a lot of these big tech companies. A report out of Reuters right now saying that Meta plans to target layoffs next month of 10% of its workforce. This is firm-wide, according to Reuters, at least.
Yeah, firm-wide, but still interested to see if there's any sectors, or not sectors, but businesses within that are disproportionately affected here. You can see the shares are climbing a little bit here. They were already higher on the day, but spiking a little bit after that Reuters headline, higher by about 1.7%.
I do wonder about this, because we've heard from some of these other big, I know someone will probably say, oh, this is about AI and efficiency, but there's also been a lot of speculation that they kind of overhired during the pandemic. But still, 10% is a huge number for Meta. And we should point out, this Reuters report says that 10% will start May 20th, but that would just be the first wave. And Reuters is saying that there will be additional firm-wide cuts later in 2026, so potentially more than 10% of the workforce.
Yeah, it's going to be interesting to see if any of their big tech tiers sort of follow suit. It feels like these big tech layoffs tend to come in waves, and at least, again, looking at Reuters reporting, we know that Meta is sort of one of the first movers here.
All right, we're seeing a drop in yields today, down 7 basis points on your 10-year. Oil prices lower, stocks at a record. A full breakdown starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell. It's a global simulcast. It started. Carol Massar and Tim Stenovic join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube on a day where we see a huge drop in benchmark Treasury yields, a 10% drop in benchmark oil prices, and a record-setting day for U.S. equities.
Yeah, pretty amazing. What we're looking at, 5, I think, is it up days for the S&P 500, a weekly gain of maybe 4.5%, about 13 days up for the NASDAQ 100. So, yeah, quite a bounce back on all this optimism that this war between the U.S. and Iran is coming to an end. But again, stuff to happen maybe on the weekend or on Monday. So stay tuned. I'm just saying, it ain't over till it's over.
That's true.
To continue with that theme, I'll talk a little bit about
I'm optimistic, but
what has happened to the Bears over the last few days. Bears have covered $93 billion. Yeah. Not the
where
sports.
Are those Bears?
I'm not a big sports guy.
Yeah.
But I don't think it's football season. $93 billion worth of short positions across U.S. stocks so far this month. The Russell 3000 and the S&P jumping more than 9% over that time. Short covering, adding momentum to the rally. How much of the momentum, Katie, has been short covering? That's the question.
Tim, you read my mind. I was also thinking about the fact that you take a look at a Goldman Sachs basket of the most shorted stocks. It's jumped by more than 13% this week. So, we've been batting around the question of how much of this is fundamental versus technical, and it looks like technicals at least has some element that it's playing here.
Well, we get the closing bells here in New York on what is going to be a record-setting day and, quite frankly, a phenomenal week, a phenomenal 3 weeks, if you will, here for U.S. equity markets, which have not only clawed back all of the losses from the war in Iran, but have actually surpassed where we were at those pre-war levels. The Dow Jones Industrial Average on the day adds almost 900 points, or about 1.8%. But let's take a look at the S&P 500. It closes at 7,126 and change, up 85 points, or 1.2%. At a record high. The NASDAQ Composite and the NASDAQ 100 each up about 1.5% to record highs. The Russell 2000, that's going to close up 57 points, or 2.1%. At a record high. And I do just want to point out quickly, we're also seeing Dow Transport surge 3% on the day to a record high.
Wow, right?
Yeah.
Just, pick your asset class, certainly among equities. We're just, and indices, you're really seeing some outperformance in a big way, the optimism. Having said that, Katie, no surprise, 395 names in the S&P 500 higher on this Friday, 106 to the downside, 2 unchanged.
Yeah, it feels like breadth has been improving this entire week. And certainly when you take a look at the circle today, there's a lot of green on that screen. Consumer discretionary was your big winner when it comes to a percent basis, higher by nearly 2%. Industrials, tech, also higher by more than 1%. In terms of what didn't participate, energy, as you might expect, that sector down about 3% as we watch crude oil just plummet here. And utilities also off by about 0.4%, Carol.
Yeah, energy's still having a pretty good year, right?
Yeah, it's all right.
We're not going to feel too sorry yet. Hey, I had a lot to choose from when it comes
Carol
to...
always takes a contrarian view. I like that about you. Yeah.
Drives my husband crazy, but I go there.
Really? You don't say.
Yeah, shocking, right? All right, so let's go to some of the individual gainers. Katie just mentioned consumer discretionary, but no surprise to see things like the cruise lines, the airlines really outperforming. Certainly some of that has to do with energy prices backing off, and you think about fuel, certainly for jet fuel, if you will. We've seen them rise amid this U.S. war in Iran. So let's just go through some of them. Royal Caribbean, guys, number one gainer in the S&P 500, up more than 7%. Carnival also riding higher, up about 7% here. United was your number two gainer in the S&P 500, a gain of 7%. Check out the S&P 500 Airlines Index. 5%, almost 5% to the upside. All 9 names in that index are higher in today's session. So we've really seen some outperformance there. Let's move on over to Strategy. MSTR is the ticker there. Yep. Bitcoin goes up, so does Strategy go up. So we saw Bitcoin going above $78,000 at one point, finishing the day around $77,000 and change. But we did see Strategy, I believe it was the number one gainer. Let me just pull it up here in the NASDAQ 100. As I mentioned, that stock, number one gainer, up almost 12% in today's session. So you understand why that one moved to the upside. And here's something different, but I feel like it plays into a wider theme that we've been talking about with this administration and certainly over the last few months and last year. And that is a company called Critical Metals. CRML is the ticker. It's about a $1.6 billion market cap as of today, thanks to a big bump to the upside, up about 35% in today's trade. Company increasing its stake in the Tambriz rare earth deposit in Greenland. Yeah. Let's see if we get back to that story.
Okay.
They're increasing their...
Can we just kind of bask in the glory of the ceasefire in Iran before we move on to the next conflict?
That's what kind of caught me when I read this one. Increasing their stake to 92.5% from 42%. So they're basically consolidating ownership of this asset that the firm hopes will serve as a U.S. aligned supply chain. Stock now up about 82% year to date. I will point out 31% of the float is short, but nonetheless, easily some outperformance there on that.
Pop quiz, Carol Massar. The best performing stock in the S&P 500 this week.
Was it Birds?
No.
Oh,
In
that's
the
not
S&P
the
500?
Sorry, that
it was
a...
Robinhood.
Oh,
nice
Robinhood.
try.
Oh, yeah.
Not really a nice try, but nice something.
You know what?
I mean,
I was doing so well.
You were.
Okay.
All came undone.
The worst performer today in the S&P 500 was Netflix. Let's start there. 24 hours ago, we were dissecting these numbers. Investors had a chance to really let them digest today, and they sent shares of Netflix down by 9.7%. The worst day going back to October of 2025. In fact, at one point, it was the worst going back to April of 2022.
Yeah.
Do you guys remember that?
Yes.
When 35% when Netflix fell after reporting the loss of a couple 100,000 subscribers 3 years ago.
That.
I'm going to say I kind of forgot that it was that bad.
4 years ago?
No, really?
That was pretty wild.
Yeah.
Anyway, how things have changed. The company forecasts earnings per share of 78 cents and revenue in the $12.57 billion range. In the 3 months ending in June, that was less than Wall Street estimates. Also, Reed Hastings stepping down from the board after 29 years at the company. But let's get to some other stocks, too, on the move. Energy stocks took a hit today. The State Street Energy Select Sector ETF, I picked the whole ETF because every energy name was down. That fell by 2.8%. This because Brent crude futures fell more than 10% today, sending energy stocks lower. Also, because of less volatility, this is a really interesting one. CME Group fell today. You also saw shares of Intercontinental Exchange, the parent company of the New York Stock Exchange. Tradeweb Markets also fell. Easing tensions in the Middle East could reduce market volatility. That drives trading activity. CME shares fell 2.9%. And finally, Figma. We do not forget about AI and the effect of AI on these stocks. Figma fell 6.9%. Anthropic launched Claude Design. It's a product that lets users collaborate with Claude to create visual work such as prototypes, slides, and one-pagers. Claude Design is powered by Claude Opus 4.7. Romaine, it's going to roll out to users gradually throughout the day.
Let's check in on yields because, of course, that was a big component of the story for the moves that we saw in equities. Equities rallying for a third straight week in yields, dropping for a third straight week on the day. That's what you're looking at here, an almost near parallel shift downward in the curve, down about 8 basis points on the 2-year yield and 7 basis points on your benchmark 10-year yield.
All right, guys, let's get to some stories that are certainly on our radar. We've got I think everybody's been kind of talking about this week. Train tickets for the FIFA World Cup will cost $150 per round-trip train ticket. The New York, New Jersey Host Committee and New Jersey Transit.
I'm so confused by this. Now, you know I don't go to New Jersey, but you're from New Jersey. Katie's from New Jersey. But I mean,
I've actually heard otherwise, but continue.
But just to be clear, I mean, this is basically on a normal day, like a $13 ticket.
Yes.
And they're raising it to $100-something. They can just do that?
It's surge pricing.
Surge pricing.
Effectively.
So can you, like the people that aren't going to the World Cup, they also have to pay this?
Well, I don't know if they're going to get to go anywhere because regular commuters from Penn Station into New Jersey will actually be suspended for 4 hours before the match.
Wow.
So they say work from home on days when there are matches. I guess my question is...
So we should mark down the days of the World Cup and just assume that nobody's coming into the office.
Charlie Pellet made the good point to me when we were talking about this earlier. He's a huge fan of mass transit. Like, there have been
He's the voice of mass transit.
Super Bowls. He's the voice of mass transit. You're right. Super Bowls, at these stadiums before, and they've been able to handle the capacity. So what's so different about the World Cup? I don't know.
That's a good question.
$150.
You mentioned the stadium, though. Do you want to talk about it? Because I find this a little bit...
Stadium? I can't wait to go to MetLife Stadium.
That's what you would think. I've been every version of myself at MetLife Stadium.
We're never coming to New Jersey. We're not letting you in, by the way.
Well,
I'm okay.
Sorry, Katie.
First of all, it's not MetLife anymore, at least when it comes to the World Cup. It's going to be called the New York, New Jersey Stadium, which is insane because it's in New Jersey. It should be the New Jersey, New York Stadium. That would make the most sense.
Or maybe just the New Jersey Stadium.
Thank you, Tim. Thank you.
You know, there are sports teams, I'm told, that play at some of these stadiums that are called the New York something.
Uh-huh.
Yeah.
I don't know.
The New York Giants, the New York Jets.
Yeah, right?
Yeah.
And they play in New Jersey.
Yeah. It's funny that,
you know that
we
Romaine?
just pretend.
Well, as you know, Tim, I stay away from New Jersey. But I am curious, though, about this. Is FIFA just holding out to get another branding here? Because that's a very generic name. I mean, no shade on New York, New Jersey, but I mean, like they couldn't come up with something creative, like
they couldn't have
soccer ball stadium.
I just don't know, but at
Pele
least
Arena.
At least for now, or at least for these games, it'll be the New York, New Jersey Stadium.
The Hand of God Dome.
Guess we gotta go.
Hey.
Katie, what's up with him today?
There's no off position.
What is up with him? Can you unplug him, please, now?
No.
Not until 5 p.m. I need him.
No. Got my medicine here.
All right, guys, have a good weekend and a safe weekend. That is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it The Closing Bell. Katie and Romain continuing on The Close on Bloomberg Television. Tim and I, of course, continuing right here on Bloomberg Business Week Daily on Bloomberg Radio. Have a good and safe weekend. We'll see you on Monday.
Our coverage continues here on Bloomberg Television. A lot of questions about what is exactly next for the U.S. involvement in the Middle East. That conversation coming up after the break, right here on The Close, right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romain Bostic here on a record-setting Friday afternoon for U.S. equities, part of a 3-week run now that has erased all of the losses that were incurred because of the war in Iran, and of course added on top of that. The S&P 500 closing at a record high, 71.26, up 1% on the day, almost 5% on the week. That was led largely by what you see on the screen, not only on the day, but on the week as well. Tech up 1.5% on the day, more than 8% on the week. Consumer discretionary stocks as a group up 2% on the day and more than 6% on the week. And looky-loo, even Bitcoin getting in on the action this day, up 3% and about 8 or 9% on the week.
Still in the 70s, but getting close to breaking out of that range. Let's talk about how this filtered through when it comes to the individual movers. Up at the top, you saw a lot of travel names really rally today, led by Royal Caribbean, higher by about 7.3%. On the flip side, energy was the big loser today. Exxon down about 3.4%. And then Netflix, I mean, we've been talking about it for 24 hours here. Their forecast leaving something to be desired when you ask Mr. Market. Shares finishing down nearly 10%. But let's get back to our top story this hour, and that is the S&P 500 heading towards its best month since 2020 on hopes of the war ending. Iran declaring the Strait of Hormuz completely open for commercial traffic, as President Trump says that Tehran agreed to suspend its nuclear program indefinitely. The president going on to say in a phone interview that a deal to end the conflict is mostly complete, with talks, quote, probably being held this weekend, Romain.
Absolutely. Here, and our next guest actually says that the fine print, of course, in all of this is going to be critical. Henrietta Treyz joins us right now, Director of Economic Policy over at Veda Partners. All right, Henrietta, I know there's a lot about those details, that fine print, that we don't yet know. But when you look at the progress, if we can call it that, over the last few days, the idea that it does appear to be formal talks, there does appear to be some sort of concessions being made on the Iran side of the equation here. Do you have some optimism here that this 10-day ceasefire will extend to 20 days, 30 days, and beyond?
I do. I think that there's a lot of countervailing headwinds here. Obviously, we know that the military continues to be deployed into the region. We have the largest buildup since 9/11. And speaking with folks in Jacksonville and the Mayport area, we know that reservists are being sent over at the 3,000 from one base, 3,000 from another. So there's still the potential for the military to get involved. But that escalation that I had anticipated, say, last week or a week ago, seems like the president has totally lost his appetite for that. And I think that's what the market is rallying towards today. And it is the best case scenario. At least we're not engaging in sort of that end of civilization rhetoric, but the details about what is going to happen to actually get this straight open, which it is not as of right now, is really where we need to concentrate, and the insurers and EU nations and NATO nations are really following that most closely, and where I'm concentrated as well.
Well, I'm glad you brought up the insurers, because we kind of forget a lot of the shutdown of the Strait of Hormuz really started, quite frankly, for more economic reasons than military reasons. The idea that, hey, if you can't insure what's going through there, no one's going to risk it. I know there is this sense here that the ships that are there want to get out. But as far as having sort of, I guess, normal traffic, or at least what would be close to normal pre-war, how long do you think it would even take to get to that? I mean, do you have any sense?
Oh, I mean, we're talking at least months, and then in terms of rebuilding infrastructure, years. But maybe that's a different conversation. The insurers are really struggling because there's a couple components. First of all, Iran is diverting traffic away from the same trajectory that we've used for the last 50 years. You've got to use a whole different shipping route. They don't know whether they can trust it. And the first and foremost problem they have is whether or not there are mines and whether they can get through it. So for Iran to say we've cleared all the mines would be very helpful, except for the fact that a week ago, they didn't necessarily know where all the mines were. So there's a lot of hesitation. And I think that's what the insurers have as their main issue. insurers are not new to, providing insurance during war times. They know how to do it. 9/11 is the example that was first given to me by some of the major international big reinsurers. But the ability to get through really just depends so much on understanding sanctions law and whether Iran wants to continue charging its ayatollah, which most Western nations are not even going to think about paying. It could be a reason why some of the ships went to try to get through the strait today and then ended up turning around. The insurers have to deal with that part as well.
And Henrietta, you also make the point in your notes that U.S. and Israeli flow is still cut off here. So talk us through the implications of that. We spent a lot of time thinking about, what this means for oil prices, what this means for energy prices. But we know that there's a whole daisy chain beyond just that.
There is a daisy chain beyond that, and they go towards growing daisies. How about that? You've got to get the fertilizer component through, right? So we don't import much in the way of crude. We've got our own. We import some of the jet fuel and other refined components, but we really are most exposed to the fertilizer front. And 70% of U.S. farmers have not bought their fertilizer for the next planting season. So if you're having a situation here, not just where fertilizer prices are A, slow to hit U.S. consumers, so that pain is still coming on that end, B, not flowing, and then C, will not be coming to the United States because our ships are not going to get through, that's your problem. And again, we're still not seeing the flow today. Hopefully, maybe next week, some things will get shaken out and the insurers can say, all right, we got confidence here and the route is sorted. But for right now, the fertilizer is really where I think some concentration and some pain is still going to be felt.
And I wonder what the political ramifications of this are, because, there's the war itself, the foreign policy aspect, but then you think about the affordability aspect when fertilizer prices, higher costs there translate into higher costs ultimately on the shelves of what people are paying for food. What do you think that this means for the Republican Party, especially as we barrel towards November and those midterm elections?
It's a fascinating question, Katie. So there's some, go back data into election outcomes, and it's not the price of gas that's really the problem. It's the fluctuation. It's the fact that Americans were getting used to, finally, at long last, a $2 handle in front of their gas prices when they went to pump gas. And now, all of a sudden, they've seen $4.50, $5 in some places. Diesel is through the roof. It's that dramatic fluctuation and chaos that really drives voter sentiment when they actually go to the polls in November. So it's a really interesting dynamic. We can absorb the price so long as it's slow enough that we don't notice. But if you fluctuate it and create this havoc, voters hate it. And that's why you're seeing the president reach new lows in his approval ratings right now.
All right, Henrietta, unfortunately, we have to leave it there. Always appreciate your perspective. That is Henrietta Treyz. She is Director of Economic Policy over at Veda Partners. Now, coming up, the NASDAQ 100 posting its longest win streak since 2013 as peace prospects send stocks higher. We'll discuss with Matt Maley of Miller Tabak when we return. This is Bloomberg. Stocks at records, oil plunging, and a VIX at bay as optimism grows over a possible end to the Iran war. The S&P 500 now on pace for its best month since 2020, and the NASDAQ 100 on its longest win streak since 2013. Joining us live to unpack the risks and the opportunities facing investors is Matt Maley. He is Chief Market Strategist over at Miller Tabak. So, Matt, clearly you just look at the price action. There's a lot of enthusiasm in this market, but reading through your notes, it seems like the vibe is not so fast here.
Yeah, Katie, although we probably should square away one thing before we get going based on your earlier conversation. The only football team in the state of New York is the Buffalo Bills.
Oh. Thank you. New York's one true team.
Seriously, though, it's obviously been a great run here, and I know you've been talking a little bit about there's been some short covering involved, but there's always short covering whenever you have a sell-off, and the initial part of it has some short covering in it. But we've had this huge run. There are when we had this last year, when after Liberation Day, that pretty much cleared the playing field for everything. There really weren't many other issues to worry about. This year, that's a lot different. Whether it be profitability of AI, which has not been settled despite what some of the fanfare has been recently, and then, of course, some of these issues in the credit markets. So we need to be careful with the market trading back at 22 times earnings again.
Yeah, and to your point on short covering, I mean, a stat we were talking about with our colleagues over in radio, Goldman Sachs, they have a basket of the most shorted stocks, jumped more than 13% this week. And like you said, I mean, you always see some element of short covering, but when you take a look at the magnitude of some of the stats right now, I mean, how meaningful do you think that is to what we're seeing in some of these big size and scopes we're accumulating in equity markets?
Yeah, Katie, the thing is, again, it's good to see this kind of buying, but, when you see, it's about short covering, but you have things like Avis Car Rental and Birds, sneakers are, there's going up several 100%. It shows there's also some froth coming back into the marketplace, and that's not necessarily what you want to see. And, it's a momentum-based market. We know that from the level of the valuations, but also I'm not as bullish as some people are on this whole issue of earnings, because yes, we've seen earnings increases. There's no question. Yeah. But it's been highly concentrated in just two sectors of the economy. I'm sorry, of the stock market. And so we have to see how those really play through as we go through the actual meat of the earnings season.
But one reason I wanted to talk to you, Matt, too, I mean, you've been on Wall Street a long time. And when you were starting your career, we were kind of coming off of, I guess, the last big, gigantic oil shock, of course, from the late 70s. But the idea that the impact of that really kind of carried through almost really deep into the mid-'80s, if you want to be real about it. And I know that what just happened over this last month or so does not compare in scale to that. But I am curious if you worry about the lingering economic impact, and that this idea that despite this rally, that in 3 months or maybe 6 months, when we start hearing from these companies again on the subsequent earnings season, we might start to hear about a little bit more pain.
Yeah, Romaine, the thing is that, like I can't remember those times back in those days. And we have to look at what happens with these oil shocks. And we've heard so much about how, hey, we had oil shocks and every single time the oil goes right back down and everything's fine. But, those are the oil shocks where oil goes up 30 or 40%, stays there for a couple of weeks, and then goes back down. But in the cases, and there's been 8 of them since the 1970s, where oil has gone up more than 60% and has stayed there for a period of time. It's every single time. It's a perfect 8 for 8, where the stock market's fallen 20%. So we're going to have to see just how much these oil prices come down. They're still up 40 or 50% from the lows we saw in the beginning of the year. And so we have to be careful about assuming that we're just going to ride right through it like we have in other lesser oil shocks.
Yeah, and so we get to this idea now, Matt, I guess as to what comes next. And I don't necessarily mean for the situation in the Middle East, but the situation for, I guess, how we price assets. When you look at where we are, 7126 on the S&P 500, you consider where a lot of the sort of, at least the big bank Wall Street targets are, which is kind of at the high end around the 7,500 mark. Is there a sense here that we could power through that based on momentum, or does this become one of these markets for the rest of the year where we're just kind of bouncing in that range of, wherever, maybe high 6,000s to low 7,000s?
Yeah, I think it's going to be hard for it to push, a lot higher like we did last year. Geez, the market rallied 40% off its lows. Well, first of all, it fell a lot more. And second of all, when we got the real good news, it was just a flip of a switch from President Trump. I mean, like I said earlier, the tariff issue was just disappeared. Well, now there's still other issues that we have to worry about, number one. But number two, the stock market's now getting quite overbought, as are a lot of the tech stocks, especially the chip stocks right now. So, it's going to be tougher for it to see the same kind of momentum carry us a lot further when you have a situation where the economy is going to have a lot of question marks because those supply chains are not going to reverse themselves immediately.
Matt, always a pleasure. Really appreciate you taking time for us. Matt Maley, Chief Market Strategist over at Miller Tabak, joining us here on a record-setting day for Wall Street. Katie Greifeld, but of course, a lot of questions as to what carries this. Is this about technicals, or are we going to get the fundamentals to back it up?
Yeah, absolutely. And we could be heading into a weekend heavy with headline risk. A lot of questions over, when we're going to see talks next between the U.S. and Iran. Reports that could happen this weekend or on Monday. Yeah,
and of course, as earnings season really starts to heat up next week with some big tech names on deck like Tesla, Intel, and IBM, investors, well, they're going to be paying attention. Ray Wang joins us in just a second, the CEO of Constellation Research. All right, we're done with the big banks, and now we move into, well, the heart of the earnings season for a lot of folks. We got some big tech names like Tesla, like Intel, Texas Instruments, just to name a few. Investors will be looking to hear fresh updates on their AI efforts, and at a time when the jury is still out on who the top dog is in the world of artificial intelligence. Joining us right now, he's a top dog in his own world. Ray Wang is Constellation Research CEO. Great to see you, Ray, here.
Great to see you.
All right, look, I mean, the AI, actually, I feel like the AI narrative has actually kind of evolved, because I feel like before it was just the extreme. It's either going to kill us all or it's going to be our salvation. And now we're kind of getting into nuances a little bit. And I think we've seen the shift in investor, at least in the public markets, where investors are starting to put their money. When you look at some of the names that we're getting next week, the Intels, the ServiceNows, IBMs, are these AI stories?
There are AI stories in each one of them. Intel, it's basically about the fact that there's not enough demand. It was too much demand, and they're making it up. So they've got CPUs because people can't get to GPUs. And they're also in the middle of their switch between foundry, their data center business, and where they go next. But the rest, I mean, software is the next piece to come back. And if you look, they were hit the hardest in the middle of that SaaS apocalypse and AI apocalypse that was going on.
But that's still kind of going on. I mean, it seems like every time we get an update from OpenAI or Anthropic or whoever else, it's always like, okay, this is the end of, name it, Wall Street, accounting, Bloomberg, or whatever. And I know that there's a lot of hyperbole and a lot of just worst case scenarios being mapped out here. But when you look at, let's just take the software landscape, and particularly SaaS, when you look at that landscape, are there some companies that are legitimately at risk?
If you don't have transactional software like data, right? If you don't have CRM data, ServiceNow, like CRM, like ServiceNow, if you think about what's going on with Workday, like these systems have real data. But if you're Figma, yes, you're in trouble. Anthropic announces something, boom, it's gone.
Yeah,
right.
And
if
that's just Harvey, coding, basically.
Yeah, and if you're Harvey going after legal market, something else is going to happen. If you're in the security space, I mean, that's going to be interesting with the AI space. But having transactional data is the big difference. You have data, distribution. More importantly, those are moats and relationships. Enterprise CIOs aren't just going to go to someone else. Their career and their companies are depending on it.
Yeah, absolutely. So data being the differentiator here. I do want to talk a little bit more specifically about Intel, because we were talking about the run in the stock. Intel currently trading at the highest level since 2000. Shares are up 90% this year. They were up 84% in 2025. I mean, you see with Netflix today how even a little bit of bad news, just a big come down with Intel. I mean, how much good news is priced in here?
Well, you see someone put a forecast for 48 as the price target this morning. I was like, oops. So what's going on is, look, there's so much demand. If you really go back and look at the data centers being built, you look at the capacity constraints on Anthropic, people are partnering with Intel because they still need CPU. They still need the chips to actually provide it. So the data center business is going to be big for them. And that transition to foundry is what people are hoping. Right? Are they going to get to 7 nanometer to 3 nanometer chips? And the answer is yes, they're going to make it.
Right. And I mean, speaking of Anthropic, I do want to get your thoughts on the upcoming potential IPO landscape. Anthropic, one of the big names bandied around, OpenAI, and then it's SpaceX. And I mean, we're talking about mega, massive IPOs. And you think about, what that could mean in terms of sentiment. Now that we're able to get quarterly updates from some of these biggest companies that are so intensely involved in the AI race, I wonder, how that sort of changes the landscape.
We're finally going to get an idea of whose business is growing faster other than just consumption of tokens. That is actually the most important thing. Anthropic, you're going to see the enterprise business. You're going to see the partnerships that they put into place are very different. They're looking at global SIs that are doing forward deployed engineers. They're building the enterprise business. OpenAI, they're going to figure out what they're going to be when they grow up. They're doing everything now, and now they've got to go focus and see where they're going to head. And then, of course, SpaceX, that's a question, is they're going to roll Tesla back in there. But think about that. That's $3.6 trillion IPOs going on once. Is there that much cash on the side in the public markets? I mean, I don't know either. I'm thinking, is the retail investment going to jump in? Because all the money's been taken out through the secondaries. So I'm really curious to see how this is going to turn out.
Me too. But before we let you go, Ray, I do want to get your thoughts on Tesla as a car company. Is it still a car company? Because I know there's been a lot of speculation. I mean, it's almost like their earnings don't even really matter anymore. But everyone wants to kind of hear whatever grand vision Musk has for it. But it seems like that grand vision has shifted dramatically.
This is about getting to space. Any space technology, you need automation, manufacturing,
for Tesla.
For Tesla.
Okay.
And so what's going to happen to me, in my mind, is I could see a SpaceX Tesla merger before the IPO.
Before, really?
And you could see this. The energy management, look at that business. As a car company, I mean, we got this email 48 hours ago that said the last Model S and Model X are now available. Would you like to buy it? I clicked on it, it was gone. You couldn't pick them up anymore. There's a commemorative edition of the Model S and the Model X for the last 100 ever produced. They were sold out literally in 24 hours, I think.
Wow. Pretty amazing. And that's probably a good note to leave it. Unfortunately, Ray, we have to leave it there. Come back soon. Great to see you. That is Ray Wang. He is Constellation Research CEO.
That wasn't you who bought that, did you?
No, that was not me.
Right.
No,
Okay.
I'm in the market for a car, but probably not an EV. Anyway, let's stick with tech and get to a company that's transforming how companies streamline and optimize their accounting and finances. It's called Rillet, and they're being backed by well-known investors, including Sequoia and Andreessen Horowitz. I'm pleased to say that we're joined now by Nicolas Kopp, Rillet CEO, as well as Alex Rampell, Andreessen Horowitz general partner and the co-founder of Affirm. So quite a lineup here. Nicolas, I'd love to start with you. Just give us the elevator pitch for Rillet. What are you actually doing, and who is your audience here?
Yeah, great to be here with you, Katie and Romain. We are building an AI-native ERP. So what that means, very specifically, we are helping accounting and finance team generate financial statements and reports a lot more quickly and accurately, and also help them be compliant in this day and age that moves ever so much fast with financial information, records to be transacted and accounted for, which is very powerful. So with that, we're powering some of the leading mid-market and lower enterprise companies like fast-growing startups like Mercor or Function Health, as well as public companies today.
And Alex, would love to hear your perspective, because I imagine that you are pitched, and you are pitched often for a lot of AI-focused companies here. So what stood out specifically for Rillet to the point where you said, I want to be a part of this in some way?
Yeah, well, I'd say two things. I like to think that the best companies are these filing cabinet companies. Like, the history of software is you take a filing cabinet, you turn it into a database, and this is everything. Sabre Systems was the first company that did this in 1960 for the airline industry. But every company, Salesforce for CRM, Workday for HRIS, the new AI generation of these now do the work. Like, you would log into Workday if you're an HR person and you do HR stuff within Workday. You'd log into Salesforce if you're a salesperson and you do CRM stuff. You do sales logging within Salesforce. They just kind of keep track of things. What's happening right now is this new generation of AI-driven companies. The AI does the work. Right? So what do I do if I have all of my financial statements and I give AI to them? It's like, oh, maybe I could do collections and automate that. Maybe I could figure out what my tariff exposure is. Not to mention the fact that I can close the books. When I was running my company, it used to take, I think, like 20 days. I wouldn't have accurate financial statements for 20 days, as opposed to, with Rillet, you've got a continuous close. So the concept of what's going to happen to software when you add AI is just transformative, because you're no longer limited to the software market, you're limited to the labor market, right? Because all the people that we use in ERP, now some of those jobs can be done by the software. So that's very exciting. Why we invested in this one was, we see a lot of companies, and honestly, we have a saying that we like a lot, which is never bet against the graph. The graph being the usage and the revenue, and this is the fastest growing company of all of the AI ERP players. So customer is always right, and we like to back the customer, and that's what brought us to Rillet and Nick.
So, Nicolas, I am curious, though, too, just also about, I guess, the accountability for accounting, pun intended, but also the idea is, who is shouldering that potential liability? Obviously, when we talk about accounting standards that a lot of companies have to follow, it's not just about, making sure things are accurate. Even if you did it in good faith and you were wrong, there could potentially be consequences. So how have you sort of structured, I guess, from your side of the business to make sure that you're not shouldering too much of that liability, and also to make sure that your customers feel confident that what they're getting is accurate?
100%. So from an audit perspective, people will refer to financial statements as accurate and complete. So both of these, you obviously need to ensure whether you use AI or you don't use AI to generate these financial reports. And so what that means very technically in our concept and of building an AI-native ERP, humans are always in the loop for final decision makings. There's very detailed, traceable audit logs as to why things are happening and what is happening. And at the end of the day, you can't rid the responsibility and accountability as a company for your financials in that regard. So whether AI has prepared it, there's always a human that will review the financial statements in its final form.
I do want to ask you also, Nick, just about the pace of development that we've seen in the AI space, and particularly with agents, and obviously what you're doing there, but on the ERP side. I'm actually been amazed by it. Even certain products and services I saw maybe 8-9 months ago, and then coming back to them today. It's almost mind-blowing. And I'm just curious if you could maybe kind of look a little bit around the corner as to sort of how much faster you think this development will be, or are we starting to hit stall speed? Like, where are we in all this?
Yeah. It's phenomenal. So even just in the last, let's say, 3 to 4 months, the pace of change with these foundational models coming out with new iterations of their models, the ability for new customers to adopt software. So for context, ERP software is traditionally very hard to adopt, implement, install, and maintain. AI helps a lot with a sort of the ability to accelerate that pace as well. It's just a compounding of R&D that's faster, as well as customer adoption that's faster. So when I forecast or like look out at least 6 to 9 months from here, I do see a world where some of the changes that it has on team structures, the changes it has on financial information that's available, will actually keep moving faster at the current pace before it gets slower.
And Alex, I do want to ask you a broader question here, because you do lead Andreessen Horowitz' $1 billion apps practice. And you mentioned, what attracted you to Rillet. It was software combined with AI. And I wonder, if that's really the sweet spot for you right now. When you're taking a look at pitches, evaluating them, what stands out to you as where the opportunities are?
Yeah, so the worldwide software market, kind of ex-cloud infrastructure, is something like $300 billion. And the U.S. labor market is 14 trillion. And this doesn't mean that labor goes away. There's not a fixed amount of labor to do. It's like everybody in 1789 was a farmer in America. But the really exciting thing right now, and the thing that we're drawn to the most, and most of the companies that are growing like crazy, they do some element of like the software is doing the work that the human user of the software would do before. So if you think about like support, customer support, you would have a customer support software application that customer support agents would use. What if you get a call in Portuguese and you don't have a Portuguese agent, an actual human to go answer the call? Like you can't do anything. The software now, you don't need the humans to go do this not fun labor that they have to do. The software application can do it. And instead of charging $100 per seat per month, well, the labor costs, like what were you paying the person that was in that seat? You might be paying them $50,000 a year. Now the software can do some of that labor. And in many cases, this is just, it's not replacing the humans. Like that's the biggest fallacy that we see. A lot of it is just expanding the market. Think about like Macy's. They hire Black Friday cashiers, then they don't need Black Friday cashiers 2 weeks from then. A lot of businesses have just intermittent demand. And one of the things that's great about a lot of these companies is they can flex into the demand that their customers have. And support is a great example of that. So the main thing that we're really looking at right now, and I've been in this business for 10 years of investing in high tech. And I've never seen companies go from like 0 to 100 in a year before, $0 to $100 million in high margin, like often profitable revenue. Many cases, we're competing not with somebody like Sequoia to win a deal. We're competing with the fact that the company is profitable because they're no longer selling per seat per month licenses. Like, I think that's dying. What's the future is like some outcome-based pricing. Like the software does so much more than what you would ever think of software doing before. And that's entirely because of AI.
All right. Really fascinating stuff. Alex, we got to leave it there. Alex Rampell over at Andreessen Horowitz. And thanks also there to Nick Kopp, the CEO of Rillet. We do have some breaking news crossing the terminal. I want you to take a look at shares of Cal-Maine. That's the largest publicly traded egg producer here in the United States, down 5%. After the Wall Street Journal reported that the U.S. Justice Department is preparing to file an antitrust lawsuit against the country's largest egg producers over allegations that they coordinated pricing through an information service that benchmarks prices for the industry. That's according to people familiar with the matter. And of course, Katie, the cost of eggs was a big topic of conversation over the last couple of years here. Now the Journal reporting that the DOJ here in the U.S. Might be on the precipice of filing an antitrust lawsuit. Well,
you remember the bird flu, of course. We saw entire flocks wiped out. Certainly helps explain that rise in egg prices, but Cal-Maine Foods reportedly a big target of this probe. We'll continue to follow that story, but let's take a quick look at how markets closed out on the week, and what a week it was. The S&P 500 higher by 4.5%, even more so when you take a look at big tech. The Nasdaq 100 higher by more than 6%. A lot of that comes back to software, and you're taking a look at the ETF IGV there, higher by nearly 14%. That is its best week since 2001. This is The Close on Bloomberg.
The push for private assets into U.S. retirement plans is now getting more pronounced. But employers, they're treading carefully for now. This is in light of the Department of Labor's proposal here in the U.S. to create a legal safe harbor for fiduciaries investing in crypto and other private assets. Our next guest says this move levels the playing field for retirement savers. Joining us right now is Deb Boyden. She's the head of defined contribution over at Schroders. So Deb, first let's start off. This looks like it's going to happen. It's just a matter of when rather than if. Are we prepared as an industry? Are you prepared for this?
Yeah, certainly the industry is very much preparing for this opportunity. And the opportunity is really for the participants of defined contribution plans. And as stated, it levels the playing field between pension plans and defined contribution plans. Now, pension plans have long utilized the full menu of alternative investments, while defined contribution plans, for the most part, have not. And with this ruling, and hopefully to be finalized around the end of the year, it will give the opportunity for individuals within defined contribution plans the opportunity to improve diversification and ultimately better retirement outcomes. And as the industry prepares for this, we are looking at different constructs that are specific for defined contribution plans. So there's a lot of innovation happening.
Yeah. One of the big issues, though, or concerns out there, obviously, as you know, is the issue of liquidity. And we've seen this, of course, over the last few months with, I guess if you want to call it gating, although I mean, I don't like that term, that we've seen with regards to people trying to pull money out of some of the actual structured private credit funds. There's this issue that in a retirement plan, you want to be able to access your money when you thought you were going to be able to access this money. So how are these products going to be structured so that liquidity is never a major impediment or concern?
Yes, that's absolutely top of mind for those of us in the industry innovating products. Well, first, the retirement investments are really a long-term play, right? We hope that those investments stay for the long term and you utilize them at retirement. But we certainly understand that there's going to be emergency situations where individuals may need access to those assets, and we do not want to be in a situation where they can't access those assets. So we are building product that will have multiple layers of liquidity, and these constructs, as I mentioned, will be very specific for the defined contribution market and very different from those constructs used in the institutional market and even in the wealth market. So that is top of mind for all of us in the innovation that is being created in this space right now.
Yeah, what I have been wondering about is, when you think about some of the stories that Romaine mentioned, certainly people getting gated, not being able to maybe leave these vehicles, a misunderstanding when it comes to liquidity, whether or not it would put a damper on sort of the retail and individual enthusiasm around having access to things like private credit. I wonder if, you've seen any murmurs of that.
Well, there is always that consideration. And again, why it's been so important for us to innovate in different ways of constructing these products. So not only will there be liquidity within the underlying private market solutions, but then there will be additional layers of liquidity on top of that. And that is brand new and not happening in other areas of the market. And again, specifically designed for defined contribution investors in hopes that we can calm those concerns.
And, it's interesting in talking with folks on this program and others about what exactly went wrong, because, again, it does seem like there was a mismatch in expectations here when it comes to liquidity. How do you make sure that folks in these retirement plans truly understand what they're getting into? Because it seems like, again, there was some miscommunication that education process did fail at some point.
Yeah, Katie, I'm really glad you brought that up. Education is critical, and education is happening now to those fiduciaries, so those plan consultants, advisors, and plan sponsors that are wanting to understand the landscape, understand the risks and rewards, and understand what the DOL rule is saying, proposed rule is saying. So not only do we need to start with educating at that level, but ultimately the individuals investing in those 401k or defined contribution contribution plans. So education has always been top of mind when it comes to investing in retirement plans, and even more so. And we have to meet the individuals where they are at when it comes to education. So that may mean educating in different ways than we traditionally have, given all of the AI that is now emerging in different ways that people are absorbing information through TikTok or otherwise and other social media.
All right, Deb, great stuff here. I'm sure we're going to talk again as this begins to get rolled out. Deb Boyden is the head of defined contribution at Schroders, as of course we await a more formal guidance out of the Department of Labor on adding those assets to 401ks. When we come back, we're going to set you up for what to watch over the next week. This is Bloomberg. We push ahead to what the markets will have their eye on over the next week, with talks over the weekend between the U.S. and Iran. But as we get to Monday here, there's going to be a lot more focus on fundamentals. Monday, we're actually going to hear from the CEO of Wells Fargo.
Absolutely. Looking forward to that. And then Tuesday, things really get interesting. The Senate will hold a confirmation hearing for Fed Chair nominee Kevin Warsh. It's going to be fascinating to see some of the sound bites there.
And earnings season really starts to pick up. On Tuesday, we're going to hear from United Airlines, which should be interesting. But Wednesday's going to be a really important day.
Tesla, IBM, Southwest, Boeing, and AT&T. And then Thursday, Warner Brothers Discovery holding a special shareholder vote on that merger with Paramount Skydance.
I think it's kind of no backsies at this point, so we'll see what that happens. On Friday, we are going to get some U.S. economic data. The University of Michigan Consumer Sentiment Survey, which should be interesting because it's going to cover a lot of the periods from the war.
Don't forget Japanese inflation data.
And Japanese inflation data as well. Katie will be here to bring you that. Join us next week, right here on The Close, right here on Bloomberg.